Hello and welcome. My name is Jason Weaver from Weaver Consulting Group. Today we're going to be talking about 3 topics in our 3 in 3 video series. So what are we covering today? Again, we're going to be talking about the current macro environment, the broadening of the market, and lastly, earnings results. So starting with the big picture, the economy is in better shape than the headlines might suggest. Q4 GDP came in at 1.4%, which looks soft, but that number was dragged down by the government shutdown. Strip that out, and the economy grew at 2.7%. The International Monetary Fund is projecting that growth accelerates to about 2.4% this year, driven by business investment. On the consumer side, spending is still solid at 2.4%, but there's a split forming. Higher income households are holding up well, supported by the stock market and potentially real estate, and lower and middle income consumers are starting to trade down. Household debt hit a record at $18.8 trillion, and there's some early strain at the lower end, but again, we'll see what happens in the coming months. The labor market continues what we've been calling a low hire, low fire environment. January payrolls came in above expectations at 130,000. Employment is stable at 4.3%, and the 2025 revisions paint a weaker picture than we originally thought. But most of the slowdown is explained by demographics and immigration shifts, not a collapse in demand. On inflation, January CPI came in at 2.4% and core at 2.5%. Both are the lowest ratings in years. Shelter costs and insurance, again, are making up the predominant share of that. Shelter is about 1/3 of the index. Still pockets of pressure, but we're starting to see that maybe things are cooling. The government shutdown may be flattering the numbers though through April, but we're definitely heading in the right direction. So let's look at this beverage curve, as we call it. Goldman Sachs is showing us a chart here of looking at job openings and that percentage rate, and then looking at the unemployment rate. As you see in 2022, we had a lot more actual job openings, but that's starting to come down. With that, of course, the unemployment has ticked up a little bit, but there's more of a balance now between the two, and we'll see what happens going forward. But if we look at these job openings, we compare that to the unemployed workers, we are seeing again that if we employed everybody who was unemployed, we would have still again 635,000 people that haven't found a job. So I would just say from these two charts, again, we are seeing some softening. That's probably going to tip the hand for the Fed, potentially to lower interest rates in the later part of the year. So let's talk about the broadening market. And we've been talking about this since last year, that we thought at some point we'd start to see the market move into other areas. Year to date, the equal weighted S&P, which is equally weighting all 500 stocks, is up 6.3%. Small caps are up 6.9%. Meanwhile, that large cap weighted S&P, which is heavily influenced by about 10 stocks, is essentially flat year to date. That tells you the averages are doing much better than the indexes suggests. Globally, the rotation is even more aggressive. Energy is up 23% year to date. Emerging markets are up 14%. Consumer staples are up again about 10%, and capital is moving into those areas. And importantly, this broadening is being supported by fundamentals. Q4 S&P earnings growth came in at about 13.2%, well above the 8.3% forecast. This isn't just money chasing other sectors, it's actually moving into sectors that have been underperforming. So what we're looking at here is a financial excess monitor. We're looking at various aspects of the economy, from the government to the stock market to household consumers. And let's compare that to 2008, where most of those sectors actually were overexposed or in a period of potential meltdown. We look at today, we only have really 2 areas that would show that we're at those kind of danger zones, looking at equities and the government itself. So businesses aren't stretched, credit markets look healthy. The 2 areas that are elevated, there are some risks there, but we think they're contained. So now let's talk about earnings results. And this is one of the most important factors when it comes to the stock market. The Magnificent Seven posted 26% growth. Despite all the headlines about tech sell-offs and concerns about disruption, the actual number shows fundamentals are intact. Now, one thing we hear a lot is that valuations are expensive, and they are. The S&P trades at a premium to historic averages. But context matters here. This isn't 1999. Today's elevated multiples are being supported by actual earnings delivery. When companies are growing earnings at 13% and consistently beating forecasts, that tells you that multiples reflect real growth, not speculation. Valuations look expensive in a vacuum, but relative to earnings power underneath them, the market is on firmer footing than the headline numbers suggest. So we're looking at an earnings visual and comparing equity valuations to the past. And the chart really drives this point home. When you're looking at it over 120 years of equity valuations measured by the CAPE ratio percentage, the blue dash line marks the 80th percentile. And what stands out immediately is that high valuations are not new and they're not necessarily a warning sign. Look at the periods where valuations stayed in the top quintile for extended stretches, from 1991 to 2008, 17 years. The market returned 230% during that time. From 2012 to today, again, 14 years and counting, we've seen excessive returns of over 427%. In both cases, macro conditions were favorable, growth was being delivered, and the financial system was functioning well. That wraps it up for 3 and 3 for this month. Thank you for watching. If you have any questions about the impacts of your financial plan, portfolio positioning, reach out to our team. If you found this helpful, please like and subscribe, as you don't want to miss future updates.